housing values can fall quite materially.
Kia ora, and welcome to a special Trans-Tasman edition of the New Zealand Property Market Podcast, brought to you by Cotality. I'm Nick Goodall, Head of Research for Cotality NZ, and today I'm joined, as per usual, by Chief Economist Kelvin Davidson, but also by Tim Lawless, who is the Research Director of Cotality across the Asia-Pacific region. Tim, thank you so much for coming on the podcast. It's been too long without having you on, so how you doing, mate?
Thanks for the invitation, Nick. How long have you been doing the podcast for? It's been quite a few years, mate. I think this is my first swing on the roundabout.
Over 6 years, and we haven't had you on, which is an absolute shocker. But I'm glad we've finally righted that wrong. So great to have you on, mate.
Pleasure. Thanks for the invitation, mate. And I'm a big fan, long-term listener.
Good man. That's a great way to start off. Kelvin, long time no chat, of course, the whole day. You well?
Yeah, going good. Yeah, bit chilly in Christchurch today, but we'll live nice and warm inside.
We'll just say, mate, we got snow here in Wellington, so we're going to claim that above you. But anyway, hey, Tim, stoked to have you on today. As you said, too long, but without having you on. So really glad to have you on, and I really want to look forward to the opportunity, I suppose, just to step back from our regular content, which is to look at New Zealand and that focus, to look at that bigger picture across both sides of the Tasman, where there's some similarities and quite a few differences as well. But before we get into that detail, I'm keen to hear a bit more about you personally, Tim. So maybe can you tell us a little bit about your career, obviously the length of time you've been with Cotality, or formerly CoreLogic, and then maybe a little bit of touch on what you do for fun outside the job on the weekends, maybe.
Yeah, absolutely. So I'm nearly my 20th year here at Cotality /CoreLogic /RBNZ to track back all the different brands the company's evolved through. And of course, in New Zealand, Property IQ evolved into CoreLogic and Cotality as well. So I started this role way back in October 2007, so just before the GFC. And it was a time when CoreLogic at the time, or RBNZ at the time, was going public. So we floated on the Australian Stock Exchange. We had some pretty significant investors like Macquarie Bank, First American, which ended up becoming our owner eventually, was also a pretty big shareholder. And then we went private when First American, which became CoreLogic, bought us out, and so we were on the New York Stock Exchange for a while there. But now Cotality is owned by two private equity funds, Insight Partners and Stone Point Capital. So yeah, it's been a long time at the helm here in the research team, but my whole career has been in property research. So before coming to RBNZ back then, I was running the research team for Colliers International. And before then, I was actually at RBNZ when it was a small privately owned company owned by the founder, Ray Catlin, who unfortunately passed now. But RBNZ bought a marketing consultancy that I was working for, which started me on my journey along property analysis, which was never my intention, by the way. I've kind of just followed the path of least resistance in some ways, and ended up finding something I'm quite passionate about. So what I do on the weekends, well, yeah, it depends on the weather. I do like my fishing, and quite often I'm a sunny coaster here in Queensland, Australia, so I'll quite often be out on the water wherever I can. If I'm not outside, then it's generally doing stuff around the house. I'm an empty nester with my wife Amanda, so the kids are in Brisbane. So yeah, it's generally something to do. There's plenty of restaurants and bars around the Noosa area, which I tend to frequent.
Yeah, no, I can certainly vouch for the old trip to the sunny coast, and having had you take me and my family out on the boat too. So I can certainly vouch for the quality of the weather up there, and obviously the experience to pop out on the boat and try and catch some fish, which all three of my children did under your watch. So I have to thank you once again for enabling that in the recently gone summer.
It was good fun, mate. Good memories.
For sure. And on the business side of things, I mean, yeah, it's hard to sort of fathom 20 years ago in the business. I've been here for 15. As you said, a lot of change over that time. But the good thing's always been the consistency with I suppose, the focus and the respect that's given towards the research and the research team, which, as you say, enables the likes of yourself, me and Kelvin and the rest of the team to do what we do and do it consistently as well. And you can certainly, speak highly of you and the team and the way that you manage things across the board to get out there and talk to clients and use all that great data we've got to to talk about what's going on, and you're a fellow data nerd like us, so it absolutely makes sense. So yeah, great to have you on and to get into some of that detail with the Aussie side of things shortly.
Thanks, mate. Well, yeah, it's definitely hard to leave when you're drinking from the fountain of property data. We're right at the source here. So it's for people like you and I that love data and love a good graph. It's certainly a good place to be.
Yeah, no, absolutely. Really well put. All right, well, let's get into it then. And I'm keen to, I suppose, set the scene first. And, from New Zealand's perspective, over the last 4 years, the post-COVID property cycle has been a lot sharper and more aggressive than what we've seen over in Australia. We did see our median value surge, sort of peak, since dropped and now really set essentially flat for the better part of 3 years now. Meanwhile, over in Australia, you've experienced more of a milder initial correction, I suppose, and that steadily climbed back toward record highs. So I guess the reason for this conversation today is that with now Australian mortgage rates heading up and inflation quite high, housing affordability quite stretched, and of course, more recently, property tax conversations have been to the fore, everyone is asking this consistent question of us, and I'm sure of you too: is Australia on the cusp of an NZ-style extended slump? Or are there some structural differences across the ditch which might protect the Australian market? So with that primer, Kelvin, can you maybe kick us off by detailing the New Zealand market over the last few years and how we've kind of got to where we are today and maybe what might be coming for the Australian market?
Yeah, so I mean, obviously, we like a lot of countries around the world, we saw the post-COVID boom. Our prices went up over sort of 2020, 2021, sort of pushing 40% over that sort of 18-month period. So a very sharp lift in property values, pretty much spread right around the country, reflecting all of those things that were going on at the time, but clearly lower mortgage rates. We got down to, a pretty typical mortgage rate, and we'll get into the fixed versus floating thing, the differences here versus Australia. Pretty typical mortgage rate here was down at sort of 2.5%. There might have been some rates even as low as 2%. So, most people were about able to borrow at sub 3%. So, that's not free money as such, but it's pretty cheap, of course. So everyone piled into the property market, a lot of investment. So property values went up a lot. But we got to the point where, mortgage payments for a typical new 80% LVR mortgage were absorbing, 50%, 55% of the typical household income. Now, not saying that's a magic number or anything, but, in hindsight, you look back and say, gee, that's pretty stretched, isn't it? So subsequently, some things changed in the economy, of course. We went into recession. We had then the Reserve Bank having to deal with runaway inflation. So the OCR went up sharply as well. Mortgage rates went up sharply. And so what we saw was property values fell pretty sharply too. They're down sort of 20% over that next 18 months. So by the middle of 23, we had seen a fall of 19, 20% from that peak. So, and since then, it's been kind of flat. So it's been, we talk about the downturn. It probably happened really 3 years ago. Since then, it's been a lot more stable. Now, I guess what we saw initially during that downturn was, sales volumes fell as well. So there was not much activity going on. Prices were falling. I guess people were sort of struggling to adjust to the new environment. But then eventually, prices sort of found a floor. People got used to that more, I guess. So then we saw sales volumes lift again. So, we've seen activity come back. We're kind of back to a relatively normal level in terms of activity. Prices still down, sort of 18% from that peak. But I guess the point is they haven't reacted because that period where sales were below normal, listings built up. So there's a lot of choice on the market. Buyers are in the ascendancy. Yes, sales have recovered. People are willing to transact, but values have stayed down. Now, that's not universal. I suppose that's one little lesson we might come to, is that it's not just one market. We're seeing Auckland and Wellington, the big centres, still pretty soft, as opposed to, say, provincial markets. You got sort of your Christchurch and Invercargill, parts of the South Island that are stronger. So, it's not one market, but yeah, it's remained pretty subdued. I suppose just in terms of the overall intro, what might be not so good for some, as in property owners, great for others. And we've seen first home buyers just piling into the market. So yeah, great time to be a first home buyer. Not so good for owners, but it's definitely a buyer's market, and that's keeping a lid on values.
Yep, no, great summary. How about in Australia then, Tim? What have been the kind of key trends, I suppose, over the last few years, maybe since COVID? And why do you think your market might have been more resilient than we've seen in New Zealand over that period of time?
Yeah, there's some similarities and there's some pretty big differences as well. We definitely didn't see values is strong. The growth in values is strong as New Zealand through the pandemic. Our national index peaked at about 25% growth in the year to November 2021. So well below, I think New Zealand was getting up in sort of the high 30s or 40s, right, in terms of annual growth. So it didn't have as high a peak to fall from in some ways. But also, I mean, through the pandemic, there was a huge amount of stimulus, and we started moving interest rates up, and all the stimulus was pretty much expired. Kind of, or the end of 2021, that started to wind down, and then rates started to rise from the middle of 2022, from basically 0 to 4.35%, the cash rate. And that was obviously the catalyst for a downturn in our market, which was really short and sharp. We saw housing values fall by 8%, 8.1% across the capital cities in about 9 months. So from the middle of 22 through to early 2023. And they started rising in 2023, not because of any stimulus coming back into the market or interest rates coming down, anything like that. It was simply about a chronic shortage of supply, which is something the market's still contending with, the fact that we're not building enough homes by a long stretch. So from 23, I mean, borders are reopened, migration had come back with some force into Australia, rental markets were really tight, and all that demand just ran into a supply constraint, which again just started to see values rising through 2023. And into 2024, it just started to slow down because of just the fundamentals were, even though there wasn't a supply response, demand was starting to wane simply because of affordability. And of course, interest rates started to come down again in 2025, dropped by 75 basis points. And that was the catalyst for this revitalization in our market through 2025, despite just stretched affordability, just a combination of low supply and lower interest rates, saw the market responding quite positively through 2025. Markets like Perth, Brisbane, Adelaide, the mid-sized capitals, we're seeing values rising, plus 20% year on year. But of course, that's all changed now. It's the market's slowed really, really quickly the last few months. Sydney and Melbourne moved through a peak either late last year or early this year, and the mid-sized capitals are following suit now. And there's a lot of focus on why that is, right? A lot of people point to the federal budget, which we can talk about later on, I'm sure. But that was definitely a catalyst for or more fuel on the fire. But before that, the budget was handed down in the middle of May. Before that, we'd seen rates going up again. So they're back to 4.35%, so another 75 basis points of rate hikes, which pretty much evaporated the cuts we saw through 2025. Affordability had become even worse, of course, because we're not seeing a great deal of income growth. When you adjust for inflation, it's actually going backwards, and housing prices had risen so much. So to Kelvin's point, looking at some of the metrics for affordability we were watching, in the first quarter of this year, households were dedicating about 48%, or nearly 49% of their pre-tax income to paying a mortgage. Chances are by the June quarter, that's even worse, given we've seen another interest rate hike after the March quarter and housing prices have risen a bit further. So, I'd say households are dedicating around 50%, maybe more than that, of their incomes, pre-tax incomes, to mortgage payments. I mean, that's on theory, right? The reality is that's not what's happening. The reality is, if you're on a median income here in Australia, you're probably not buying at the median price, simply because you can't demonstrate an ability to service the mortgage. So, and that's probably one of the reasons we've seen a lot stronger price growth across the lower price points. So lower quartile housing markets have generally been seeing some resilience. They've been outperforming. Not to say those markets are completely insulated, but there's a lot more demand at those lower price points as well. But even there, we're seeing values starting to flatten out or fall across that lower quartile as well. And it looks like we're probably done with rate hikes now. It looks like inflation's starting to come down, at least the headline numbers. Core inflation, which is at 3.6%, is holding firm, and probably will start to come down as well. So there's no longer this expectation that rates will rise further from here. Although, as we all know, those forecasts can change pretty quickly depending on the data flow. But yeah, for now, it looks like we're probably in a situation where there's going to be a lot less investment in the Australian housing market, given the changes we saw through the budget being handed down. And a lot of first home buyers are just holding off, waiting on the sidelines, even though it's a much better time to buy. Confidence is deeply pessimistic, which is a pretty big hurdle for most buyers.
Oh yeah, for sure. I mean, I was going to sort of touch on that because I think that's something we've seen for a while, is that particularly confidence in the economy here in New Zealand and in their job and labour market has been pretty weak for a prolonged period of time. So I think, can we focus on that for a little bit, Kelvin, the role that has played? Even this week on the podcast, Kelvin, we spoke about, labour hoarding in the job market and the role that's playing on people's nervousness around what they do, whether they invest in property, whether they move house, those types of things. So how much of sort of New Zealand's prolonged weakness do you think is directly attributable to that employment insecurity and that weak consumer sentiment, rather than just interest rates and some of those other key fundamentals we speak of?
Yeah, probably all tied up together, really. It's always hard to disentangle all of these things. An economist talks about the counterfactual. We never quite know what would happen without that factor or, another factor. So always a bit hard to disentangle it. But I guess, yeah, sentiment has definitely been low, and it's hard to measure. It can turn on a dime. It's one of those things that I guess you're always in circular arguments. Is it confidence itself that's low and that's keeping transactions low, or is it actually the other way around? The circularity can go both ways, I guess, or the causality. But yeah, the moods have been pretty subdued, and we've been talking a lot, I guess, about, is this a structural change? And it's maybe something we dig into more deeply a bit later in the pod. But is this structural? Have we reached a point where actually people have permanently changed their mindsets around capital gains and house price growth, and even when the economy recovers and even when financing gets a bit easier, all these things, have people just fundamentally changed? And that would be to do with things like possible tax changes in future, a lack of a downwards trend in interest rates, more housing supply. There's a massive difference between here in Australia, if you look at the charts, and yes, we've had a construction downturn over the past sort of 2-3 years, but we're still building quite a lot of houses. That downturn came from an incredibly high peak, so we're still actually at a decent level in terms of construction. So, physical supply has adjusted, and you just don't hear the word shortage here much anymore. It was a big thing for a while, and you just don't hear that word anymore. So, I think, and that can become circular too, if people believe that supply will always be able to adjust in future and be more responsive, then they naturally sort of pare back capital growth expectations because they just know supply will be there. So I think that's all sort of tied up. One thing, I guess, obviously mortgage rates have played a big role in it, obviously the weakness of the economy, but as I say, there's a circularity there with sentiment too. And we might just be at a point where that mindset structurally changes to do with all of those factors I just talked about. I guess just one thing I'd add is what we haven't seen, and I think that's to do with, okay, we have seen the unemployment rate go up, but it's been more about new people coming into the labour force rather than job losses. And so I think that's had different implications for the housing market, because people have kept their jobs. They're the ones who will have the mortgages. They're the ones who will own the houses. They've kind of been getting by. I mean, yes, they've seen on paper the value of their property go down, but they've been able to service the debt. They've still got an income, and so we just haven't seen non-payment problems, repayment problems, mortgagee sales, that sort of thing, because the unemployment rate has gone up more because of new workers coming in. Okay, not great for them. They can't get a job. They won't be able to get a mortgage, but the housing market implications or the knock-on impacts to repayment problems just haven't really been there. So, that's something that, even though we've had a pretty deep and prolonged downturn, those repayment problems have perhaps been missing compared to previous cycles. So, but I think, ultimately, that physical supply, I think, has been a biggie in terms of just changing people's mindsets and I guess their expectations around where the market might go from here. And, as I say, it all feeds back on itself. And, maybe we're at a structural turning point. We'll only know when we look back in the future. But, confidence has been part of it for sure.
No, that's definitely true. And I think that, yes, it sounds more like, the economy obviously hasn't been growing or strong at all, but it also hasn't been completely gutted out. It's not been mass recession where, as you say, yes, there's been headlines and plenty of jobs that say they're not employing and they don't fill vacant roles, but they haven't been making mass job losses. That's not to say there haven't been some out there, but in the grand scheme of things, they're relatively small from an economic perspective. Over there, though, Tim, it seems like your economy has been much more stronger in the post-COVID phase. It's been growing more. Certainly we get plenty of headlines here in New Zealand about all the New Zealanders that leave here to go to Australia, where it's typically a higher wage economy and there's more jobs they can get, or for similar jobs, they're earning more money. So it feels like it's been quite strong. Where's the economy at right now? Is it starting to show those signs of weakness? You're not seeing that growth anymore. Where's the labour market and unemployment at? Is that where the weakness is starting to come through, and that's what's weighing on that sentiment as well, if you start to see that acceleration of job losses?
The economy hasn't been strong. Maybe as an outsider, it might look strong, right? Because we haven't gone into a recession. But when you look at the GDP data, I'll start there. We've gone through quite a few quarters of negative GDP growth when you adjust for population growth, right? So per capita GDP has been negative to flat, right? And so part of the reason we've sort of staved off a recession is simply because of population growth adding to economic activity. But there's also, the most recent GDP update's a great example. There's been a blend of significant capital investment in things like data centers, for example, that seem to be holding up the GDP numbers. And there's been a huge amount of government spending as well, which, is a topic of debate every week, right? Here in Australia is how much government debt is being racked up and how much is spending. A lot of the labour force data, which I'll talk about in a moment, has been supported by growth in the public sector as well. So, once you start to dig down a little bit, the economy doesn't really come across as strong as what it might seem. Like the labour numbers, unemployment bottomed out in the high threes, and it's tracking at about 4.4% now for unemployment, and not really moving too much. It's loosened up a little bit. Underemployment has risen a little as well, up to about 6%. But overall, the labour market is looking quite tight. And that's one of the reasons why we're seeing really low arrears rates here in Australia. Mortgage arrears about 1.6%. That includes 90 plus and less than 90-day arrears. So most people are definitely keeping on top of their mortgage repayments, despite the fact that household indebtedness is very high. It's not quite at record levels, but it's close to it. And most of that household debt is housing debt. About 70% of it is. When you look at a few other areas of the economy, inflation is still quite problematic. It's one of the reasons, probably the reason why we've seen interest rates rebounding back to the cyclical highs, 4.35%. And a lot of that, again, is not really from consumer spending or any sort of, exuberance from consumer spending. It's more about higher utility costs, fuel prices, electricity costs have jumped severely. The government for a while there had a energy rebate, which is probably, it's definitely provided a little bit of alleviation to the consumer costs, but it just plays havoc with the CPI numbers as the rebates come and go as well. Core inflation obviously is less volatile, but still it's been quite high, and housing inflation is a big part of that. So rents are up. The cost to build new homes is up quite substantially. Utilities flows into the housing CPI as well. So housing CPI is 6.8%. Headline CPI is 3.8%. So it gives you a bit of an idea about the focus on housing inflation. That doesn't mean like higher housing prices, transacting prices are fueling inflation. That's not how it's calculated. But definitely building costs are a big part of it. We're seeing our rental index growing at about 6% year on year. And it's accelerated, probably maybe starting to plateau out just through rental affordability pressures, probably putting a ceiling on how high it can go. And then, of course, you've got building, right? Construction, which Kelvin talked about in some detail. We're kind of the opposite here. We're definitely not building enough, especially in relativity to the boom in population we've seen when borders reopened. And even now that we're seeing a more normal rate of population growth, in percentage terms, in raw numbers, it's quite a bit higher than pre-pandemic. So that in itself is adding to housing demands. The factors that are really a barrier to building more are multifaceted. We've seen a surge in building costs through the pandemic. that hasn't gone backwards. We're generally seeing construction costs rising at a more normal pace, but a bit of re-acceleration through the June quarter this year is oil prices started to influence construction costs. But it's also labour. Like construction labour is just extraordinarily tight, and it's competing with a huge amount of big public infrastructure projects as well that generally compete for the same inputs, both materials and labour as well, and arguably better conditions for labour in the big public infrastructure sector projects. And finally, on the construction sector, you've also got this absence of productivity improvements. You know, the Productivity Commission over here in Australia put out a report a year or two ago that was measuring productivity across the country, which has gone up about 50% in 30 years. So we're more productive as a country, but across the residential construction sector, in 30 years, physical productivity has declined by 12%, and raw productivity, when you don't adjust for quality, like larger homes and stuff, is backwards by 50%. It's extraordinary. So watch this space. I think you'll find that we do start to see a lot more innovation coming into the building sector around modular construction, prefabrication, digital printing of homes, all that sort of stuff, as well as really just trying to get a more productive outcome from the labour force as well, which is definitely a hard ask.
What about from a land use perspective? I mean, one of the things that we talk about contributing to the significant increase in the amount of building being done in New Zealand, particular Auckland, was the Auckland Unitary Plan, which was confirmed in 2017-18, allowing more intensification and densification closer to the city and closer to transport hubs. Have you guys got decent ability to build and intensify closer to cities? Or I've heard some conversations around, states in Australia looking at what's happened in Auckland, where we have seen that response to being able to build more and more intensely close to the cities.
Yeah, it's definitely happening here as well, at least from a planning perspective. So definitely state governments. Well, let me take a step back first. So town plans are set by local governments, kind of like a TA, I guess, in New Zealand.
Yeah.
And then state governments are more responsible for like infrastructure development and capital investment. And then federal governments are responsible for setting like migration targets and population growth. So there's a disconnect between all three layers, right? And so while you'll have town plans are becoming more receptive to density, particularly along transport spines and where there's been a big investment from the state government around train lines and busways and light rail and stuff like that. Well, I say it's on paper, practically, it's really hard to actually deliver on that stock. So for developers over here, they find that because construction costs are so high, they just can't get a feasibility to stack up. It's not profitable to build medium to high density unless it's really high spec boutique styles of development that are of a premium price, and they're generally catered to downsizers or high net worths, something like that. To get something mainstream into the market, it's almost impossible to build for a profit. So to do that, we need to either see more productivity, which I just talked about, or you need to see governments taxing less. There's some estimates that new developments per dwelling are about 30,000 in taxes, or about 30%. 30% of the construction cost comes back to levies and charges and stuff like that. So it's definitely happening in some markets, and clearly Sydney and Melbourne have densified around their CBDs and some of the secondary cities like Parramatta in Sydney. But it's a pretty slow-moving beast, and there's still, I think, from a consumer appetite, generally the preference still lies in space, in greenfield. So detached homes in the outer fringes, which implies really expensive to build all the infrastructure connecting those outer-lying areas and make sure there's enough amenity and so forth as well. So, yeah, I think like a lot of countries, we acknowledge the challenge and the problem. We're trying to fix it, but the reality of doing so isn't straightforward.
Yeah, I mean, the quarter acre dream is still alive and well, right? Like, I think it is here in New Zealand too. We have seen through necessity, some first home buyers do move towards those type of townhouses because it's all they can afford. But as soon as things loosen back up and prices haven't gone anywhere, they absolutely go and favour those houses once again too. So, yeah, it's hard to get out of that mentality, I guess.
Yeah, so we call it the great Australian dream over here, right? Of, your quarter acre block and detached home. Yeah. Is it the great Kiwi dream in New Zealand?
Yeah, the quarter acre dream, same sort of thing.
Okay.
Yeah. Yeah, same sort of thing. So yeah, I think it is true on both sides of the equation. It's still there. It's not going to go away in a hurry. Yes, we're going through some generational change, but people still, if they can get it, they're going to go and prefer that rather than in shared ward units where they're a bit closer to the neighbours, and there's all a few things that come with that. But I think we're seeing some change in mindset, but not completely the other way, and it's going to take some time for that to ever really take control. So yeah, definitely a changing space, and I think we've seen some modifications, and maybe you've seen bits of that already. I know that you've also been building units for a lot longer, like more units than houses for a long time across many of the states in Australia too. So in many ways, we've finally caught up with that. And because we haven't had the same population growth, we've managed to eat into some of that supply deficit, but it's still taking some time to truly make sure that we're not undersupplied as we were in the past. But all good. We'll move on from that, I suppose, physical supply of things. I do want to touch on something that's been spoken about earlier on very briefly, and that is, I suppose, the mortgage structure in both sides of the country, interest rate pass-through in particular. I'm really interested in the fact that you guys, what did you say your interest rate was? 4.35 term, which means what? Interest rates might be...
Rate.
That's the cash rate. So interest rates are up at 6% on them, getting those variable rates. Can you talk to us about the structure of those interest rates? Do you talk about the neutral interest rate for that cash rate as well? And that's why you're talking about no more as inflation. You sort of said it seems to be under control. I know we've got the big unknown of what happens in the Middle East, and that could lead to continued high prices for things. But where are expectations on interest rates? And is that the squeeze that's coming on now too? Is that one of the key factors?
Well, up until just recently, the June inflation data came out last week, and up until then, there was still speculation we had another 25 basis points of cash rates ahead of us. Some economists thought there might be 50, but since the inflation update, which came in a bit softer than everyone expected, we generally see most economists agree that there's no more cash rates in the wings unless something unexpected happens, which is always a risk. So banks that were forecasting another 50 basis point of rate hikes are now forecasting zero, right? So hopefully that helps to boost sentiment a little bit. Typical variable mortgage rate for an owner-occupier in Australia is about 6.2% now. For an investor, it's about 6.4%. And to your point, Nick, most borrowers are taking out variable rates. It's always been the case here in Australia. It's upwards of 60%. It's pretty hard to actually get the split these days. The ABS used to publish it, but they don't anymore. But I'm guessing it's upwards of 60% would be taking out a variable rate. And if you're not on a variable rate, you're probably on a short-term fixed rate, kind of like New Zealand, around 3 years. Longer than that's quite rare, up to 5 years. So fixed rates are a little bit lower now. So 3-year fixed rate for an investor is about 5.6%. So variables at 6.4%. For owner-occupiers, it's about 6.1% for a 3-year fixed rate compared to 6.2% for a variable at the moment. This is for new loans. If you're an existing borrower, loan interest rates can be a little bit different, of course. So there seems to be some reward for non-loyalty across the banking sector for swapping and refining. So you might get a lower rate. So it's definitely highly competitive, and no doubt with rates relatively high, there is going to be a lot of shopping around. A lot of borrowers have quite a bit of equity up their sleeve, given come out of a decent amount of growth as well. So yeah, where to from here? I'd say, well, fingers crossed, rate hikes are done, but that doesn't mean they're about to fall. I think, again, it looks like we're in for a period of stability, and at the moment, it looks like the middle of next year, maybe when we start to see some downwards pressure on interest rates.
So that would be because you want to get that cash rate back down to a neutral level, and as a neutral level, 3 to 3.5%.
We don't have an official, decree of what a neutral cash rate might look like. You're probably right. It's probably somewhere around the mid to high threes, I would say. The RBA sometimes tries to theorize what the neutral cash rate might be. Some economists try as well, but it's highly theoretical. And I'd probably agree it's somewhere in that mid to high 3% range.
Yeah, I mean, that's just a stark difference to here, right? We've just moved to 2.5, expecting a neutral, maybe 3.25. So we're still in stimulatory phase, and yet we haven't seen prices grow for a long time. And yeah, you're certainly on the flip side of that, and especially if your next move is going to be down, even if it's in a while time, then that's going to be it's just so different to here. So Kelvin, do you want to talk through the structural differences for New Zealand? Obviously the fact that we're on the fixed terms, what those rates are like at the moment, and I suppose you can wrap into that the expectation around where to next, the New Zealand rate as well.
Yeah, I mean, our floating rates, I was just checking quickly as Tim was speaking, they're pretty similar. A floating a variable rate here is around about that 6% mark. The thing is, nobody really takes those rates. So if you look at the structure of all existing mortgages right now, about 90% of debt is fixed for at least some period of time. I guess the tenor of that debt or the structure of that debt lately, in the past sort of 6 to 12 months, has been getting longer. For a while there was a greater interest in floating rates or very short-term fixed rates of up to 6 months. That's been getting a little bit longer lately. But the point is, whether you're fixing for 6 or 12 or 18 or 24 months, whatever it is, fixing is just more popular regardless of that term. So yeah, right now about 90% of existing mortgages by value are on a fixed rate of some duration. So yeah, very, very different. And I guess from a monetary policy perspective, it does just make the Reserve Bank's job here a little bit harder because the pass-through is going to be longer. I guess they're trying to not only account for the lags in the inflation measure, there's always lags in the economy and lags in inflation, but also how the housing market interacts with that too, because there's going to be lags in terms of when mortgage holders at least feel that pain when interest rates are going up, or on the flip side feel that benefit when they're coming down. So it does make things a lot more complicated in some ways, I guess, but it's just interesting that structure has always been an interesting thing that has always struck me about our different mortgage markets. And from what I understand, just simply comes down to the way it's funded, how banks price it. Floating rates are attractive in Australia, fixed rates are attractive here, so it might not be too much more than that. But yeah, I mean the bank switching and sort of loyalty and all of that was brought up there. I mean, we've seen a massive lift over the past sort of 12 or 18 months in terms of bank switching or refi. I believe cashbacks aren't a big thing in Australia anymore, but certainly here that's been a big incentive for borrowers here to switch banks is pretty generous cashbacks. You switch your loan and you get some free money basically. So that's been part of it, as well as simply the fact for a while there a lot of people were either on floating rates or more generally fixing as short as they could, so that the structure of debt, even though it has been lengthening, it's still a wee bit shorter than it used to be. So people have that opportunity to switch without having to pay break fees or anything like that. So we've seen a bit of a refi boost as well, and I suspect we'll probably stay that way for a little while because it takes time for it to feed through the system for people to truly stretch their loans out again. So there could be a bit more refi to come. And the only other thing I was going to say just earlier around mortgagee sales and to do with the unemployment rate and that sort of thing, part of what we've seen here, I guess, over 15, 20 years has been a ramping up in credit standards, I suppose, not only enforced by the Reserve Bank around LVR rules, DTI rules we've got now, but also, I guess, internal servicing tests, which isn't necessarily mandated by the Reserve Bank, but the banks themselves really making sure that not only people can afford the mortgage at 5%, whatever it is now. You asked about a standard rate. Most people would be borrowing now on, say, a 2-year fix of around 5%. But it's not only so that you can afford it at 5%, but also the bank will say, hey, could you afford it at 7%, for example, if things went that way. So, the serviceability testing has probably weeded out some risky loans before they've even got the loan, effectively. So I think that's been a big part of, I guess, why we haven't, even though the downturn in prices has been deep, people have, the credit standards have still been pretty high, so people have serviced that debt and it perhaps hasn't flowed through to mortgagee sales that we might have seen in the past. So the credit side of things is very different.
That's a good point. I mean, you've got the same thing happening in Australia, right? From APRA. I suppose you guys definitely have the serviceability test. Is it 2 or 3 percentage points above the actual interest rate, Tim, over there?
Yeah, it's 3 percentage points. For a while there was 2.5. It got lifted in October of 22, I think it was, or 21, during the pandemic. So it got tightened up a little bit when rates were like 0. So yeah, there is an argument from some that a 3 percentage point serviceability buffer is too conservative. Probably blocks people from accessing credit. But to your point, Nick, we've got really low mortgage arrears, maybe too low, and definitely a very strong prudential system behind the banking sector as well.
Yeah, and so no other restrictions like on loan to value ratio rules or debt to income restrictions that are enforced by APRA or the Reserve Bank of Australia at all?
There used to be. So we went through a period of macroprudential around speed limits on investment credit growth. That was back in December 2014, and then a 30% limit on interest-only lending. But both those rules got removed in 2018. The current macroprudential measure, apart from the serviceability buffer, is a 20% limit on high DTI lending, which is measured across both investors and owner-occupiers separately. But that's completely non-binding at the moment with interest rates where they are. So it's pretty much a preemptive strike from APRA, I think, that was initiated from February this year. That it doesn't really have any influence on the market at the moment. But when interest rates do start to come down, it might be more binding.
Yeah, okay. Well, that's similar to us now. We only got the debt to income rules brought in last year and definitely not binding. It might have been the year before, was it, Kelvin? But definitely not binding. Similar thing, 20% of lending being able to be done. So, yeah, maybe we're caught up to you on that one. But as you said, kind of doing nothing at the moment anyway. So, yeah, interesting. A few more similarities, a few more differences there. That probably brings us to the last section I want to talk about, and that is taxes. Of course, this has come to the fore with the reform over there off the back of the budget. So, Kelvin, I thought maybe you could just give us a bit of background on, when you look at our buyer classification data in terms of, obviously, you talked about earlier, first home buyers hitting record highs, but we've seen those investors, those multiple property owners, be less active so far this year, and certainly a few years ago they pulled back from the market. We've had a number of changes over here, whether that's interest deductibility being removed. We also had the ring fencing of losses changed a longer time ago. So, yeah, do you want to talk about how those tax rules and changes from central government itself has affected our market here in New Zealand, which might give some guidance as to what the Australians can expect? And then maybe, Tim, after that, you can talk to us about those changes, exactly what they mean and how it's being seen on the ground.
Yeah, so I mean, right now, no broad-based capital gains tax in New Zealand. If you buy and sell within a 2-year period, and unless it's the family home, you will pay capital gains tax. So there is something of a capital gains tax called the bright line test, but it's only within the first 2 years. So if you hold for 3 years, you're off the hook. So that's kind of our current tax setting. We also have a 100% interest deductibility right now, so investors can offset all of their mortgage interest against their income to reduce their tax bill. So we're in I guess right now we're back to where we were at certain points in the past, I guess a middle of the road sort of tax setting. But one thing that changed going back to 2021 was the Labor government at the time lengthened the bright line test and also started to phase out interest deductibility. So, those were, particularly that interest deductibility one was a pretty big change for investors. So, you were effectively getting taxed on, it didn't go all the way, but if they had stayed in power and had fully phased it out, you were getting taxed on revenue rather than profit, and that did create a lot of angst against property investors. Now it is potentially back on the table with a change of government possibly coming up in October. Who knows? We'll see how the November, I should say. See how the election goes. Now that's something that investors right now are a wee bit concerned about, it's fair to say. But right now, the tax settings as they are now under the current government, I suppose, are pretty conventional. You touched on the negative gearing thing there. So back in 2019, the Labor government at the time ring-fenced property losses within property, basically. So up until then, you could use a loss on a rental property to reduce your tax on your wages or your general tax bill. From then on, they ring-fenced it to say, okay, you have to keep those losses within a property portfolio. Yes, you can use any losses now to reduce tax on a profit later, but it has to be ring-fenced within property. So effectively took away the negative gearing that Australia's been pretty hot on lately. So, but we had that was taken away in 2019. Subsequent to that, investors still bought rental property. So, yep, we never know the counterfactual, but go through 2020 and 21, we actually had a massive boom in property investment, even though negative gearing had previously been taken away. So, I don't think the removal of negative gearing necessarily sort of kills property investment, but obviously it does change the way people approach it. But the experience from here is that, you can still have property investors even with negative gearing taken away. I think the big thing that has been on investors' minds here is probably more that interest deductibility, because that's a real hit to cash flow, and that does change things. So, that's the experience from here anyway.
Yeah, yeah, no, I couldn't agree more. I suppose anything on the bright line test is that I think there's still the intent rule as well. So if you do buy a property with the intent of selling it for a profit and it's 2 years and 1 month, you can still be taxed on that. But obviously, it's a lot harder for them to get the appropriate documentation, I suppose, to say you're always intending on selling that property over that period. You can always say my situation changed. But there is one little trick for players there to be mindful of. If any Australian, I suppose, was looking to come over here and own it for just over, they could be got by that one. But yeah, take us to your side of things, Tim. I think particularly now we're a few months since that announcement of those tax changes around negative gearing. How are things settled down now? There was this massive influx of, oh, everyone's going to go buy property in New Zealand because Australians won't have to pay tax over there. Do you feel like that's really going to happen? Do you see that capital coming across to New Zealand? How are the investors now feeling about it? I mean, it's not confirmed yet, is it? I suppose it's still looking likely, but it's not confirmed yet.
No, it is legislated now, so it's law. So just a quick summary: what was handed down in the federal budget on May 12th. So negative gearing, as it existed, is pretty much only available if you buy a new home now or land to build on. So negative gearing is simply, I'm sure everyone understands, it's if you're making a cash flow loss on your property, you're going to offset that loss against your taxable income, so you pay less income tax. And at the same time, they also change capital gains tax concessions. So if you own your home for more than a year, historically, you'd always get a 50% capital gain discount, which helps to adjust for the inflationary influence on capital gains. Now they've switched to an indexation approach where they're trying to factor in CPI or inflation more specifically, which is a bit more complex and probably won't provide as much of a discount as the 50% rule that previously existed. So again, if you buy a new home, then you can take a choice. You can get a 50% discount or a CPI indexation, whichever works out better for you. So arguably, I mean, if CPI was really high for your investment period, then you're probably in a better position. But yeah, it's probably a low chance of that happening. So since then, there's a lot of anecdotes. There's very little hard evidence. So we've definitely heard a few of the big banks here in Australia talking about the drop in inquiry. So one bank announced 3 weeks after the budget, they'd seen about a 20% drop in investment inquiries. Another bank just recently said they've seen about a 30% reduction in inquiries, but didn't break it out by investors versus owner-occupiers. My guess is, I mean, coming into the budget, investors were about 41% of mortgage demand in Australia, which is quite frothy. Normally, investors are about a third of demand. And they're going to be cooling anyway because investors tend to follow the market cycles, and the market was already cooling down well ahead of the budget. So we're already expecting investors would cool down. But I think with this new rule, given Australian housing is really low yielding, gross yields tend to be well below 4%. In some markets, they're closer to 3%. Net that out, you're looking at net yields probably closer to 2 to 3% at a time when mortgage rates are high and holding costs have gone up massively as well. Just higher insurances, higher strata fees, higher maintenance. There's a lot of tenancy reform underway. So I think a lot of investors are just going to do the maths and say it's too hard. The holding costs are too high. I don't get any sort of reward for the risk I'm taking on the home. And they'll probably look at other asset classes until yields improve substantially. So my best guess is we'll see investors going from about 40% of demand to maybe 20% of demand, which is a pretty chunky aggregate of demand coming out of the market. But you'll probably find first home buyers do pick up a little bit from here as well. And first home buyers have been pretty active, right? They've got a lot of stimulus. They can get into the market with a 5% deposit, and the government will guarantee, so they'll pay mortgage insurance. There's stamp duty concessions. There's first home buyers grants, all sorts of stuff which they can use. So chances are, once confidence returns, that's the missing piece of the puzzle, you'll probably find first home buyers do become more active. Investors are absent for a little while. Some will deflect to buying new, but most probably won't.
Yeah, okay, really interesting. And I think, yeah, certainly that's the thing we've been talking about for a while is that lack of confidence. Once that returns, especially now our affordability metrics are back to a more normal level in New Zealand, that we'll see some growth come back. But yeah, you're still, I suppose, being at that squeezed level of affordability, maybe that still holds things back to some degree. But as you said, for first home buyers who have got all those exceptions that they can use, then maybe they can still continue to act to some degree. But investors are certainly going to find it tougher to make those finances stack up. So it's going to be a lot more restrained in the future. What about them buying here in New Zealand? Is that something you think is real, or a bit more of scaremongering in Australia to get those rules changed?
Yeah, I think it was a bit of hype, to be honest. And as soon as investors found out they'll still get taxed on their capital gain by Australia, they probably became a little bit more cognizant of what it really means. So, yeah, I mean, anecdotally, yeah, I think New Zealand will probably at the margins get a little bit of overflow, but yeah, I'd be surprised if there was a flood of Australian investors coming into the NZ market.
Well, they'll keep, coming and buying in Queenstown anyway. We know that to be true. They continue to do that and probably always will, but who can blame them either? Everyone from outside the area, Aucklanders and Wellingtonians and Cantabrians and Aussies alike. So can't blame them for that, that's for sure. All good, fellas. Well, look, we are going to have to wrap up very shortly. I suppose we're going to have one last question for each of you and then opportunity if there's anything else we've missed out today. So we'll throw it straight back to you, Tim. If you had to give Australian buyers and policymakers one key lesson from the New Zealand cycle in the last, 4 to 6 years, what would it be?
Absolutely, it would be the fact that housing values can fall quite materially. So, I mean, New Zealand's still, 17% down from peak or so. If we saw Australian housing values fall by that much, it would be quite the shock. The biggest declines we've seen in Australia over the past 40 years are the two most recent ones where values were down 8%, or a little bit more than 8%, but 8.1, 8.2. And we're probably heading for something a little bit bigger than that now, but maybe 10%. So, yeah, I think it's clearly that, an economy can withstand a material fall in housing values and still see some improvements in affordability from it and a pickup in first home buyers.
Yeah, we try to put that out all the time, right? Falling in values doesn't have to be a terrible thing because it's not good for those individual homeowners who see their equity decline, but doesn't necessarily catastrophic for the broader economy either. So, yeah, I like that one. And then to you, Kelvin, what can New Zealand learn from some of Australia's market mechanics as we look toward, 2027 and maybe even beyond?
Well, I suppose during this past 4 or 5 years, where our market's been pretty weak, and Australia's has still been growing. I suppose it's it's the economy stupid. That old phrase. If you can once you start from a better position in terms of affordability, if your economy's going okay, yes, there's been some per capita challenges in Australia clearly, but if you get some economic growth, you're starting from a better base from an economy and an affordability perspective, then you're probably going to see some housing growth. But I think Tim's point, absolutely, that's what I was going to say too. Is you can see pretty big downturns in housing markets. That's the thing that New Zealand has seen, and yet life goes on. We've still been functioning. It disadvantages a group of people, property owners, but it benefits another. And I think the big difference. I come back to that supply thing. If we do get a mindset shift here and a permanent structural change in people's attitudes towards price growth, capital gains, I think it's going to stem from that supply response. And I think the conversations we have much more common now for people to really just say, ever rising house price is not the best thing, is it? And if we can get some more supply and keep affordability structurally better, then that's probably going to benefit us. So that seems to be a big difference between here in Australia right now. There's still some supply challenges there, but if you can keep affordability at a better level, you probably have a better functioning housing market.
Well, especially it sounds like in the new build sector too. Need to see it more affordable to continue to build those properties. So that's maybe the one thing missing. But no, well said. All right, well, I'm going to give you both one chance for any final words. Kelvin, you can go first, and then we'll give Tim the final words today before I wrap up.
Oh, gee, not a lot to add. I think that's New Zealand and Australian housing 101 in a nutshell, whatever. I mean, great chat. I've had to look into this issue a little bit for client presentations over the past sort of month or so, and it's just been really interesting to get the stats again, do those comparisons, housing affordability, structure of debt, all of that. So, I guess be interesting to see where Australia goes. Does it follow New Zealand? We'll wait and see.
Yep, indeed. And any final words from you, Tim?
From my perspective, Nick, I think the Australian housing market, it's always a national pastime in many ways. The next 12 months are going to be really interesting, right? Where we don't expect the market to be throwing a lifeline anytime soon. And probably the next sort of catalyst for any sort of improvement will be lower interest rates, but that's probably second half of next year sometime. So you'll probably see the headlines quite negative for a little while around housing markets. But the silver lining, of course, is looks like some good opportunity for buyers. Stock levels are high, prices are coming down, affordability is starting to improve a little. Hopefully the economy keeps on chugging along, because that's the wild card here is government's going to be missing out on a lot of stamp duty revenue. Confidence and housing markets are inherently linked as well. So let's see what unintended consequences we start to see coming along the way.
Yes, indeed. Well, buckle in, I suppose, and we'll wait and see what happens. But that's amazing. Well, thank you so much, Tim, for joining us from Australia. Can't believe it's taken this long, but great to finally have you on and get a chance to pick that massive brain of yours. So I appreciate you coming on.
Thanks very much.
Well, good. And Kelvin, as per usual, mate, thanks for your thoughts, for giving us the New Zealand breakdown. And I think, because you've had that recent context of comparing the markets, you've been able to jump beyond and between and give us that context. So I appreciate all your thoughts as well.
No worries. Always happy to chat.
All right, fellas. Well, thank you very much. That will do us for today. Thank you very much for listening. Please do get in touch with any questions on topics we could cover or thoughts for future guests we could have on as well. Always keen to hear what you reckon we could be covering. But as I say, thanks once again. My name is Nick. They're Tim and Kelvin. You've been listening to New Zealand Property Market Podcast and Australian Market Podcast. Mā te wā.